Mr. Evans. This video looks at a really important financial document that's important in analysing financial performance, which is the balance sheet. So we're moving on to this section 3.7.2, all about analysing the existing internal position of a business. So this is part of the SWOT analysis, and this section is about ratio analysis. But before we get into ratio analysis, it's really important that you have some understanding of balance sheets, income statement, and then we can get into what these ratios mean. So PLCs every year are legally obliged to publish financial documents in their annual report. One of them is a balance sheet and one of them is a income statement. So we'll start off with the balance sheet. A balance sheet is a formal financial document. Formal means that it needs to be published, and there are guidelines for how it should be published, the language that needs to be used and how it should be set out. So it's a formal financial document that shows the net worth of a business at a given point in time. In other words, it's like a snapshot, a picture of a business. How much is this business worth today? It balances the assets a business owns with the liabilities it owes. Now, I always think about, when thinking about these two financial documents, the income statement and the balance sheet, when we hear people talking about celebrities and sports stars and musicians on TV, we're sometimes told this person is worth £10 million, or this sports person is worth $200 million, or whatever it is. That's different from this sports person earned this amount last year. This musician earned this much income last year. The balance sheet is that answers that question: what is this business worth? So when you hear someone is worth a certain amount of money, that just shows that they have assets, which are cars, houses, money in the bank, shares maybe, etc. And they've probably got some liabilities, and when you take those liabilities away from the assets, if they sold everything and paid off their debts, how much money would be left over? And that is what the balance sheet tells you about a business. Now, balance sheets are really complex, and it is worth getting your head around them. It's going to take you some effort to understand all the new language that you will need to require to be able to access a balance sheet and understand it. And there's no substitute for that. Just like you would do if you were learning a new language, you need to sit down and you need to go through by rote, and you need to learn all of these key terms. When you know the key terms, you can understand, you can access it, and you can use this financial information to paint a picture of an organisation. The balance sheet will give you information that you can't see about a company elsewhere, but only if you understand the key terms involved. So here are some of those key terms that you need to know. A balance sheet will tell you the non-current assets. So it sounds complicated, but assets are things that are used to generate income for the business, and non-current basically means these things are going to be used to generate income for the business in the long run. So these are things like vehicles, factories, machinery. Their worth will be detailed in the balance sheet under the heading non-current assets. And when I say a formal financial document, all of these terms are kind of official terms that have to be used. As opposed to non-current assets, we said that non-current assets, they're going to be used for longer than a year to generate income. Current assets are going to be turned into cash within a year. And there are three specific current assets that I won't get into right now that will sometimes be detailed on a balance sheet. So non-current, they're going to be used for more than a year. Current, going to be used to generate income, generate cash within the next year. So we've got liabilities as well. If assets are something that you own, liabilities are something that you owe. And non-current liabilities are debts that are due to be repaid in over a year's time. So things like bank loans would be a typical example of a non-current liability. We're not due to pay it back within the next year, but it's bank loan, mortgage, this is something that's hanging over the company and will need to be repaid at some point in the future. And in contrast to our non-current liabilities, of course, we have our current liabilities, which are our debts to be paid within the next year. So the balance sheet gives us a really important piece of information. Now, this isn't actually detailed on the balance sheet, but you can work it out very easily by taking your total current liabilities from your total current assets. So, in other words, if we're getting this amount of money from our current assets, turning into cash within a year, if we take away our current liabilities, we're going to see, are we going to have enough cash to pay off our debts? And if the current liabilities are greater than our current assets, in other words, if we're going to need to pay out more money this year than we're getting in, that's going to be a big worry for a business. So that's a really important role that the balance sheet plays. Finally, a balance sheet details equity. And equity is just a posh word for the total amount of money that has been invested into a company by the owners or the shareholders. Now, I've got an example of a balance sheet here, and I will talk you through it as quickly as I can. But again, it might need you to pause this video or go and find another example of a balance sheet, because at first glance this seems really complicated. And what it takes is effort and learning to get comfortable with what you're being told. So what we're told is this business has non-current assets of 100 million. So if it sold off all its factories, machinery, vehicles, etc., they'd get 100 million pounds. Now, these inventories, receivables and cash, inventories is the total amount of stock that they've got. Receivables are the money that they've already sold goods to these people. They're just waiting to get the money owed by debtors, and cash as well. So we've got these three current assets that are either already cash or very close to being cash. Okay, and in this business, that's worth 40 million. This business is going to owe 35 million in the next 12 months. So that leaves them with a working capital. Their net current assets are 5 million. It's not called working capital on the balance sheet, it's called net current assets, and they're worth 5 million. So if we add non-current assets, 100 million, total current assets, we've got 40 million. We take away 35, and that's what these little brackets mean. 35 means brackets means that's leaving the business. Currently, we've got total value of the business of 105 million. We then need to have a look at our non-current liabilities. Okay, so that's all very well saying we're worth 105 million, but in the next couple of years, we're going to have to pay off some long-term debts worth 25 million. Which makes our total net assets, if we sold all of our current asset, our non-current assets, all of our current assets, if we paid off all our debts that we owe, this business is worth 80 million. Okay, so that's how that 80 million comes across, and you can see I've put that in bold. The reason is we need to find out where that money has come from. Where's the equity come from? And what we're told is that the shareholders have invested 70 million. When people have bought their shares, that's given the company 70 million pounds in share capital, and their reserves and retained profit is worth 10 million, and that makes 80 million. And you can see these figures balance, which is why it's called a balance sheet. This is everything the business owes. This is where the business owns, and this is where the business got the money from. And a balance sheet should always balance, which is why it's called a balance sheet. Just one more thing that is worth noting is that you can work out the total capital invested in a business. If you add 80, that's the total value that shareholders are invested, to the non-current liabilities, in other words, the money that they've borrowed from the bank, that gives us 105, and that would be the total capital employed. The total equity plus the debt capital gives us 105. Now, I know there's been a lot of information in that. It's worth having a look at a textbook, watching through the video again to make sure you understand it. This is an example of a balance sheet that was provided for the 2017 summer exam series in A-level paper 3. Just very quickly having a look at these figures, well, we can see that in both 2015 and 2016 they're going to get in more money than they owe in the next year. We can, I'm not going to do the calculation, but we can see that they're getting in more money than they're going to owe, so that's promising for the business. However, I'm alarmed by this non-current liabilities, because they've got non-current liabilities that are worth more than the actual business is worth. So that would be a big cause of concern, I would say. What's the purpose of a balance sheet? Well, it helps to judge the size of a business in monetary terms. It helps us to answer that question, how much is a business worth? It's to show what a business owns and what it owes. It gives an insight into how the business is managed. So, for example, is this business holding a large amount of stock? Does this business have a large amount of cash sitting around doing nothing? If it does, maybe that suggests that the business is quite risk averse and they should be investing that cash into new assets. It can identify potential liquidity problems. In other words, is this business going to be able to pay off its debts in the next year? It helps us to understand the extent to which a business is funded by equity or debt capital, which also helps us judge the risk of investing or lending money to a business. Okay, if a business has already got loads of debt, I don't particularly want to invest in that business, maybe, or certainly would think twice about lending them any more money. What are they doing with all of this money that they've borrowed, and will they ever be able to pay it back? And it allows us to compare performance and trends over time. Okay, so balance sheet, a lot of information. Suggest you go away, learn all of those key terms and look at plenty of examples of balance sheets so you're comfortable with analysing them.